Welcome back to the deep dive. Today, we're going deep on all this stuff about timing the market.
Oh, yes.
You know, that whole idea of buying low and selling high, like you're going to be smarter than everyone else.
Right.
But you know what's funny?
What's that?
We found some pretty surprising stuff. Like, did you know that some of the biggest single-day gains, like in the U.S. stock market, happened in 2008?
Oh, wow.
Of all times, like the financial crisis.
Yeah.
Everyone was freaking out.
Right.
So how does that even happen? We got to figure that out.
Yeah, well, it's interesting because we always think about bull markets as, like the steady climb up.
Yeah.
And then bear markets are like a straight drop down.
Right.
But your sources actually point out
Yeah.
that it's way more complicated than that.
2008 is like the perfect example. I mean, overall, it was a horrible year for the market.
Right.
But get this, 4 of the top 10 highest single-day point increases ever in U.S. stock market history happened in 2008. In that one year.
Crazy.
Yeah.
And the top 2 record-breaking jumps, those were also in 2008.
Can you imagine selling everything because you're like, oh, no, the market's crashing?
Oh, man.
Right before one of those jumps.
That's got to be painful.
Talk about missing out.
Big time.
But, okay, so why did the market suddenly go up during a crisis?
Well, your sources point to the government and what they did. Like all those bailouts and stimulus packages. They were trying to like stabilize things, And sometimes those moves cause these
jumps.
Yeah, these sudden jumps upwards. Even the pros, they didn't always see it coming.
Really?
Yeah, a lot of big funds did pretty bad in 2008. Because they missed those upswings.
So it's not just about being smart.
No.
It's about being lucky, too.
Yeah.
Which is basically impossible.
I can't predict it.
To predict.
Right.
So we can't time the market in the short term.
Yeah, that seems like a bad idea.
Super risky. But what about predicting the big stuff?
Like what?
You know, like those long-term trends, like economic crises.
Right.
Could we have seen 2008 coming and like gotten out before it all?
Before it hit.
Yeah.
That's the question everyone wants to know the answer to.
All right.
And that's what we'll look at next.
Okay.
Your sources dig into this, and let's just say they challenge some pretty common ideas.
Oh, really?
About how much we can actually predict these big market swings.
All right, I'm ready for it.
Okay.
Let's go.
Let's do it. Okay, so we've seen how hard it is to time the market in the short term.
Yeah, those lightning strikes.
Right, you can't really catch them. But what about those like bigger shifts in the economy,
Right, the ones that really shake things up.
Yeah, like 2008.
Yeah, exactly.
Could people have seen it coming?
And like gotten out of the market before it all went down.
Yeah, a lot of people think that's how it works.
Like the experts knew it was going to happen.
Right, but your sources, they say it's not that simple.
Oh, really?
Yeah, they use 2008 as an example.
Okay.
Even if you knew a crisis was coming.
Yeah.
Saying exactly when it would hit. Like 2008 versus 2007 or 2009?
Yeah.
That would have been impossible.
As you're saying, even predicting the year is hard.
Yeah, forget about the exact month or day.
Right, right.
And here's the thing, there were warning signs.
Before 2008.
Yeah, like the housing bubble.
Oh, yeah.
Those risky subprime mortgages.
Nah.
Debt was going up.
Like red flags everywhere.
Exactly. But most people, even the experts,
they missed them.
They missed them or didn't think they were that important.
Hindsight's 20/20, right?
That's what they say.
Easy to connect the dots after everything's already happened.
Exactly.
But in the moment, it's way harder.
Your sources talk about Michael Burry?
Oh, yeah, the guy who bet against the housing market.
He's the one, he saw the warning signs early.
Like way before 2008.
Yeah, like in 2005, he started shorting subprime loans.
Wait, hold on. Remind me what's shorting again.
Okay, so basically you're betting that something will go down in value.
Okay.
In this case, those subprime loans.
Got it.
If they go down, you make money.
But if they go up?
You lose money.
So it's risky.
It is very risky.
Okay, so Burry shorted the housing market in 2005.
Right.
What happened then?
Well, for years, people doubted him.
Really?
Yeah, he was under a lot of pressure.
I bet.
Because his investments were going the wrong way.
Oh, man.
But he turned out to be right.
But imagine the stress.
Yeah, you got to have guts to stick with it that long.
It shows you that even if you're right about what's going to happen, the timing can still mess you up.
Totally. And your sources, they have another example.
What's that?
Comparing the Chinese market in 2007 with the 2008 crash.
Okay.
So in 2007, the Chinese market was booming.
Yeah, I remember that.
This index, the CSI 300.
Yeah.
It tracks some of the biggest companies in China.
Uh-huh.
It went up by 160%.
In 1 year?
Yeah. Crazy, right?
That's insane.
But then 2008 hit.
And everything crashed.
Yeah. The whole world felt it.
So if you had timed it perfectly...
You had made a ton of money in 2007.
But if you got the timing even a little bit wrong...
Yeah, even a little bit.
You could have lost a lot in 2008.
Exactly. And that leads to another point your sources make.
Okay.
Even the pros messed this up.
Really?
Yeah, people with tons of experience, they still try to time the market.
And it doesn't work out.
And it often ends badly.
So who are we talking about here?
I'll tell you next. All right, so your sources talk about this guy, Julian Robertson.
Okay.
He ran this fund called the Tiger Fund.
Okay.
This wasn't some newbie.
Yeah.
I mean, this guy had an average annual return of 31.7%.
Whoa!
For like 20 years.
20 years.
Almost 20 years.
That's insane.
Yeah, he was beating the market consistently.
So what happened?
Well, he was value investor.
Meaning?
Meaning he looked for companies that were like undervalued.
Okay.
Like the market wasn't giving them enough credit.
Got it.
And this worked great for him.
Yeah.
Until the dot-com bubble in the late 90s.
Oh, yeah.
Remember all those internet companies with these huge valuations?
Yeah, they were going crazy.
But they weren't making any money.
Right. It was like everyone was just throwing money at anything.
If it had .com in the name.
Exactly.
And Robertson being a value investor.
Yeah.
He saw this as a classic bubble.
Makes sense.
So he decided to short those tech stocks.
He bet they were going to go down.
Exactly.
But I'm guessing it didn't work out.
Well, the bubble kept getting bigger.
Oh, no.
And his short positions, they led to big losses for the Tiger Fund.
Ouch.
And he was facing pressure from investors.
I bet.
Because the fund was shrinking.
Right.
So he decided to close it down.
When was this?
March of 2000.
Wait a minute. Right before the bubble burst.
Talk about bad timing.
Oh, man, that's gotta hurt.
Yeah, just weeks later, the bubble popped.
And all those tech stocks.
Well, they crashed.
And he would have made a ton of money.
If you just held on a little longer.
Wow, so even the best investors.
Yeah. Get caught up trying to time the market.
It happens to the best of them.
So if it's so risky to time the market, what are we supposed to do?
Well, your sources, they have some ideas.
Okay.
Remember that S&P 500 study we talked about?
The one where if you held it for 20 years...
Yeah, you got a good return.
Even though there were ups and downs?
Exactly. That's the power of buy and hold.
Right. You just buy and hold on.
You ride out the waves.
But isn't that kind of like just putting money in the market blindly?
Not at all. You still need to do your research.
Look, what kind of research?
You got to understand the companies you're investing in.
Okay.
Their financials, their growth potential, all that stuff.
So it's more about making informed decisions.
Right. Not just reacting to the hype or the fear.
Got it. So buy and hold is one option.
Yeah. There's also dollar cost averaging.
Oh, yeah. I've heard of that.
So basically, you invest a fixed amount at regular intervals.
Like every month.
Exactly. So you put in $500 every month.
No matter what the market's doing.
You're not trying to guess when to buy or sell.
Right. You're taking the emotion out of it.
And you end up buying more shares when prices are low.
Exactly. And fewer when prices are high.
Which means your average cost per share is lower.
Right. I like it.
So the main takeaway from all of this...
What's that?
Successful investing. It's not about being smarter than the market.
Yeah.
It's about having a strategy, doing your research, and then sticking with it.
Patience and discipline.
Exactly. Even when things get tough.
So instead of trying to time the market...
Right.
Maybe we should be more like gardeners.
I like that.
You know, you plant the seeds.
Yeah.
You take care of them.
And you watch them grow.
That's a great analogy.
Thanks.
So for all you deep divers out there, here's something to think about.
Okay.
We talked about why timing the market is bad.
Yeah.
But what if we flipped it?
Interesting.
Are there any times when timing the market might actually work? Or at least be less risky?
I like that. What would you look for?
Yeah, what kind of research would you do?
Yeah.
Something to think about.
Right. Keep those brains working.
Keep learning.
Thanks for joining us on The Deep Dive.
It's been fun.